Good morning, everybody. And obviously, thank you for taking the time out of your busy schedules to be with us this morning. My name is Steve Philp, and I'm a director at Portugal Pathways and your host for today's webinar. Today, we're discussing a topic that is of major importance to UK expats living in Portugal, and the proposed inheritance tax changes that is expected to come into effect in April 2025. And the impact that this will have on UK pensions from the recent UK government budget. Obviously, I want to sort of take a bit of time to introduce our panel, and our panel will be taking questions sort of throughout this sort of 30-minute webinar. So if you've got any questions, any comments, we really encourage you to leave those in the chat. And if we don't get the chance to get to all of those questions, we will reach out to you to obviously arrange a discovery call with our experts and to answer those questions for you. So just to get going, I really want to introduce to you our panelists, our experts today. We have joining us today, we have Steve Sayer. So Steve is the technical sales manager at the Utmost Group. Utmost is a global provider of wealth management solutions such as international insurance bonds, which many expats consider when they're leaving the UK for Portugal. They don't sell directly to consumers. Instead, they work with independent financial advisors. Utmost have over 100 billion under management with their IFA network and bank. So welcome, Steve. And joining Steve, we have Chris Marsden. Chris is the managing director at Beacon Global Wealth Management, a wealth management firm based in Portugal and specialising in supporting UK expats with cross-border asset structuring. And finally, joining Steve and Chris, we have Niall McDonald. Niall is a partner at Beacon Global Wealth Management, and he brings hands-on experience in helping clients move pensions and assets out of the UK to secure their financial future. And Niall can give advice both in the UK and in Portugal. So big thank you to our panelists for joining us today. I want to dive into the main topic straight away, and I want to ask the panel, what are the big changes in the UK budget around inheritance tax? So I've got a slide to put up. I'm going to ask Steve just to talk to this.
Yeah, thanks, Steve. Just briefly before I start, I have to say that neither Utmost Wealth Solutions nor myself are authorised to give financial advice. We only provide the financial products to authorise it through authorised intermediaries. And any information that I give out or say about the budget today is purely of a technical nature. So, having said that, what happened in the budget? And of course, it was a lot that happened in the budget, a lot of changes. Some £40 billion of tax was the aim of Rachel Reeves to raise to fill this proverbial black hole. And she did this with a number of, well, big changes, I suppose, ranging from changes to things like national insurance as far as employers are concerned, ranging to capital gains tax changes up to obviously 24% now. But as for the topic of today, she made some big changes to inheritance tax. Now, what were those changes, or what are those changes, and when will they take place from? They're going to take place from April next year, April 2025. And it's going to be a completely different system for determining whether an individual is liable to UK inheritance tax. And perhaps more importantly, what assets will they be liable to inheritance tax on? Now, just a little bit of background, I'll make this fairly brief, is under the current system we have in the UK, whether or not an individual is liable to UK inheritance tax is determined by their domicile or their deemed domicile. What is that? basically it's the country, I suppose, that they regard as their permanent home. And the issue is if an individual is UK domiciled, then they'll be liable to UK inheritance tax on all their assets wherever they are situated, inside the UK or outside the UK. Now, if an individual is not UK domiciled, he or she no longer regards the UK as their country of permanent settled intent, then they're only liable to UK inheritance tax on assets situated in the UK. And that's quite a simple solution, but it's not really, because in order to lose your UK domicile when you leave the UK, well, it's notoriously difficult. You've got to move to another country. You've got to establish roots in that country. You've got to look upon that country as your country of permanent settled intent. You're going to live there for the rest of your life. If you move countries, then your domicile reverts back to the UK. And in which cases, of course, what that means is you've got UK inheritance tax liability again on your worldwide assets. And so under the current situation, this domicile test that determines the inheritance tax liability is something that individuals could never be sure whether they've lost the UK domicile or not. And ultimately, whether they had lost the UK domicile would be a matter that would be determined by the courts. Now, the great news is with this budget is that from April 2025, we're going to be moving away from that system. We're going to be moving away to what is going to be a long-term residency test. And the beauty of that is it's a mathematical formula. You satisfy that you've been outside the UK for, well, up to 10 years, and you're no longer deemed to be long-term resident, which means that you've got no UK inheritance tax on assets situated outside the UK. So major change. And of course, the people that are benefiting from that is those UK nationals, those UK domiciles as they are now, who have been able or are able in the future to leave the UK for over 10 years. They can now, after April next year, plan with certainty. Also worth mentioning the major change for inheritance tax, because it will impact many people, is that for the first time, well, next year, any pension death benefit is also going to be brought into the UK inheritance tax net. So lots of major changes, lots of planning opportunities.
Lovely. Thank you, Steve. Niall and Chris, is there anything that you guys would like to add to what Steve said before we sort of move on?
I can go,
Okay.
Steve. So yeah, no, it was very well covered there as well by Steve at Utmost. We're very grateful to have him on the webinar. So thanks for the kind of comprehensive answer there, Steve. Covered most of the points. From my perspective, the big changes, as Steve's rightly mentions, around IHT or inheritance tax. So inheritance tax or death and estate taxes has been around going back probably now to the 17th century. So there's been a significant shake-up now since the new governments came in force. I read somewhere actually that the UK inheritance tax is the 4th highest in the world. Haven't verified that, but certainly it shocked me when I seen how high up the rankings we were. But again, just to kind of summarize what Steve has mentioned, I think the big change is the move from the domicile basis now to the residency style basis. And really from ours perspective as advisors, it brings with it a host of opportunities that previously were very, very difficult to consider for the UK expats. So from our point of view, from our perspective, it's definitely a welcome change in our arena.
Brilliant. Thanks, Niall. Obviously, this is a question which I think I know the answer to, but I just think, Chris, Niall, I mean, it seems an obvious question, but who are the big winners in this budget, do you think?
I'll take that one, I think, because it is an easy one. I think hopefully everybody on this call is a big winner from this budget. I think UK expats in general have the ability to, as Niall said, to plan and to avoid UK inheritance tax by structuring their affairs properly, and that is immense. I mean, if you some of our clients down here in Portugal, they have properties, they're on non-habitual residency, so they're on NHR, and they've been down here 8 years. As soon as they're down here, I mean, they're already having benefits, but as soon as they're down here 10 years, they are totally outside of the UK inheritance tax net. And where that means is, let's for example, you got a villa down here at a couple of £1 million. That was costing you £800,000 up until April next year. The moment you go through that 10 years outside the UK, that falls outside of UK IHT.
Yeah.
Now, these are huge areas and complicated areas. The reason we've got Steve from Utmost on the call is because Niall and I's technical knowledge is good. Steve's technical knowledge is great. So what we do is, we work with guys like this to be able to structure and work with our clients to give them the great benefits that are coming. I mean, I can't emphasize what a great big change this is for UK expats. Wills need to change, structuring needs to change, sites, where your assets are based need to change. There's so much out there, and it really is. Anyone on this call who plans to be outside the UK for 10 years is a winner.
Absolutely. I mean, again, just thanks for clarifying that, Chris, and for everybody that's on the call. If you need to talk to a wealth management company and a tax expert to get that sort of peace of mind and clarity, which I'm sure you will and you do. I mean, Portugal Pathways can facilitate that, and it's a no obligation initial discussion with the guys, Niall and Chris, and obviously Beacon Global Wealth Management. So again, reach out to us. My colleagues will be putting obviously contact details within our chat, or you can obviously visit our website and contact us via that. Obviously, what I'd like to do, and this will really help sort of illustrate things, is to sort of walk the audience through a case study, a real world example, if you like, of what this might look like for somebody. And I believe we have some slides and an example from a widowed expat called Edward. So I'm just going to put those slides up, and I think Chris and Niall are going to talk through that. So bear me 2 seconds. Here we go. So this is obviously the case study. So I don't know, Niall or Chris, do you want to sort of take that one on?
I'll run through kind of the second bit. Do you want to run through the first bit, Niall, with that? Just who this client is, because I believe it's someone you know and someone you met and played golf with, that type of thing. So it helps, doesn't it?
Yeah, of course. So just to run through what we've got on the screen there. So it's a typical client that we would encounter here in Portugal. Roughly 60 years old, on their own, at the moment, would be considered not long-term UK resident based on some of the technicals. Currently based in Portugal, assets roughly 3.2 million. That's probably kind of not a standard profile, but that's the sort of client that we would typically come across and see where we're based in Portugal. And it's surprisingly, when you start adding up the assets, how quickly the numbers begin to increase. And with the increase in values that have been going on in the last 10, 15 years, it doesn't take long for those numbers to steadily increase. But we've provided a little bit of a breakdown here. On the left side, you'll see the UK asset value. Middle column states the asset type. And then on the right-hand side of the column, you've got an overseas asset value. So running through the numbers, on the left-hand side, we have 1 million based in a UK-based house. And then on the right-hand side, roughly the same 1 million in a property here in Portugal. Again, that sounds high, but the residential prices are certainly what they are. And again, it doesn't take long for those numbers to be round about that equation. I know, Steve, you'll be desperate to come in from a technical point of view on residence bans and nil rate allowances and things like that, and certainly can add so in a second. But just to run through again some of the other numbers, we have 200,000 from an ISA. Typically, we'll see a lot of clients who have built up their ISAs, rightly so, over the preceding years. But we'll see how that sort of plans out in the next few slides. And then again, roughly in other assets, 500,000 sitting in the UK, and then 500,000 overseas. So quite simply, from a UK position, we've got 1.7 million based in the UK and 1.5 million based overseas, or in this case, Portugal. Therefore, the client has the combined 3.2 million in assets. Moving on to
this one up.
Yeah, absolutely.
Yeah. Okay. Yeah. So we're just a different voice. So what we're looking at here is what are the excuse me, what are the IHT liabilities that Edward has if he dies pre-April 2025. So pre-April 2025, he is still UK domiciled. The new system doesn't come into place, and as you can see here, his overseas assets and his UK assets come to 3.2 million. When you take out his allowances, which are nil rate bands and residence nil rate bands, which again, we can go into, but basically it means he's got an IHT liability of over £1 million in the UK as it stands at the moment. Post April 2025, if he keeps his same asset split, so he still keeps assets outside the UK and he still keeps assets in the UK, so he doesn't do anything with his UK property and he doesn't do anything with his UK investments, so his ISA, maybe his pension and his 500,000. You can see there that he still has a liability even after you use his and his wife's nil rate bands of £280,000 because he's left assets in the UK. What he could have done, and what we will talk to clients about, and only if it's the right thing for them and only if it becomes what they want, what they need to do is we can reduce that liability down to zero, because if all of his assets are overseas assets, so he keeps his villa in Portugal, he keeps his assets in his investment assets in Portugal, we do something about his property in the UK and realize the assets from there, we do something about his investments in the UK and move those, we do something about his pensions, and all of these things will be individual. So each person that we deal with will be slightly different, but we can reduce what is now £1 million liability in the UK to zero after April 2025, as long as varying different areas are met. Now, I think anyone would say, if by sitting down and talking to a wealth manager and they can save you £1 million just by structuring things differently, it's probably worth us all sitting down and having that conversation. That's what needs to be done for anybody that is planning on being 10 years outside the UK. I think from a client point of view, this is one of the biggest changes to taxation that could make a difference to what you do. The investment return you have to get to change, to save £1 million is quite a lot. So let's start having that conversation, I think, is where we are. Are there any comments you want to make, Steve, on the technical side?
Can I just jump in quickly, guys? I think there's a little bit of interference. I'm sitting here at my end, so if we're not speaking, if we go on mute, we might sort it out. No, yeah. Thanks.
Yeah. Okay. Just one thing, Chris. It's quite interesting as well, because in that final diagram there, it's assuming that all assets are now held outside the UK. Of course, practically that may be the case, but it doesn't have to be, because that individual would still, if he had a UK inheritance tax liability, he would still have potentially nil rate bands and residence nil rate bands available. And if he's widowed and his spouse hadn't used them previously, then he could also potentially use the transferable nil rate band and transferable residence nil rate band, i.e., he could potentially still have assets up to £1 million in the UK, and because of the impact of those various nil rate bans, he would not have a UK inheritance tax liability. So it's very much individual planning that needs to come to the fore here, but it can be, very, very worthwhile, even if he has some residential properties in the UK.
Absolutely, yeah. Thanks for clarifying that, Steve. So having more assets move from the UK is massive to many people in terms of the impact inheritance tax could have if you don't get professional advice early on. What practical steps do UK expats need to take to ensure that they benefit from these changes? Niall, can you sort of take that question on for me, please?
Yeah, sure, Steve. Apologies if there was any feedback there on the microphone. So I'd say, firstly, if you're on the webinar, congratulations, you're on the right path. I would then encourage those individuals to look at their finances, their assets, their income. I would ask them to look at how it's structured in terms of what it is. I'd then ask them to look at where it is, given in light of what we're talking about, whether it's UK based or overseas. So there's a couple of questions that they would need to ask themselves. I would also ask if the current structure is tax efficient, and if they're aware of what the implications are regarding, for example, income tax, dividend tax, capital gains tax, and then what we're talking about here, inheritance tax, to name but a few. And then just find out what their exposure is to those things. I mean, again, we haven't talked about anything to do with investments. It's a tax sort of based situation right now. But yeah, it'd be a case of looking at their current assets, where's it structured, and what's their exposure to the various degrees of taxation. And working with the clients, we sort of work through those in sequence. Quite often they are codependent, so what you do with one affects the other and vice versa. But it's very important to understand where you're at and then make sure that we can make any adjustments or recommendations or based on where they're at and where they're trying to get to.
Thanks, Al. So just sort of staying with you quickly. So what's your advice for someone who may not have looked at their UK-based pensions and other UK-held assets as of yet?
Yeah, I mean, if you haven't, it's okay. You're in the norm. You're not doing anything that most people haven't done. But I would certainly encourage you to seek professional advice with regards to an advisor or lawyers or accountants. Again, just to understand where they currently reside. But the first thing in many things is always to have a look at it yourself. So make sure that you know your own assets, where they are, what they're doing. And once you kind of have an idea of that, then I would suggest, speaking with those professionals that can really give you the advice, because it's quite a complex area. Whilst relatively straightforward, it is very complex.
Yeah. Chris, anything you want to sort of follow behind on?
Yeah, I think, when we're talking about UK pensions and what we can do there, is that Niall's right. We have to look at everything. We have to look at how the assets are structured. But the key bit is knowing that what's happened. The changes that are coming down the line for you. The changes that are coming down the line for you, really do give you an opportunity to have a look at and review all the planning you've done, because there will be different changes. How you're set up in the UK might now need to change to how you're based in Portugal. And when we work with clients, it's very much on the basis of, okay, let's get the clean sheet out. Let's see where you are, and let's see. It might be you're in exactly the right position, which is great. It might be that actually we need to make a few changes, and then we can go from there.
I think we wanted to bring sort of Steve in on this as well. From
so if we're looking at on the UK pension side of things, I always think it's great talking to some of our technical guys and people we know, because now they're bringing UK IHT into pensions. I've heard some horrific numbers But I'd like someone like Steve to tell me. I've heard numbers over 60%, Steve, that could be the real taxation levels on UK pensions that are left in the UK because they're subject to UK OHT. What's the actual number, I guess?
The actual number varies between clients, obviously, Chris. So basically, the headline rate is that one of 40%. That's the inheritance tax rate, the main inheritance tax rate in the UK. Of course, the issues start to come into play is that if the holder of that pension died after the age of 75, because if they die at the age of 75, then any benefit has to be paid. Well, it will do two things. One, it may impact their availability of the residence nil rate band to be offset against the rest of their estate. And briefly, what happens there is if you've got an estate in total worth over 2 million, UK taxable estate worth over 2 million, the residence nil rate band that's available reduces on a £1 for every £2 excess basis. And what that means is that if you are in that tranche, if you like, you've got an effective 60% inheritance tax just purely because that residence nil rate band comes down as well. But it doesn't stop there either, because if you die over the age of 75, then the asset from that pension scheme has to be paid out or will be paid out as income to that beneficiary. And let's assume it's one of your children who's a beneficiary. They can obviously take all of that pension as income. And if it's income and they're a UK taxpayer, then they'll be paying income tax on that benefit coming out. And of course, that can be in England, Wales, Northern Ireland, up to 45%. So that can all add up to an effective tax rate on that pension post 2027, under those circumstances, of 89.49%.
So hold on, Steve. Sorry. So you're telling me what that for every pound that I put into a pension, 89p of it could go in tax?
Yeah, more or less. I'm not saying every pound you put in, but every pound of value that your pension is, then 89.49p will go as tax. Yeah, and I mean, I've got to say as well, Chris, just for the sake of completeness here, that's assumes an additional rate tax that's payable by the beneficiary in the UK. Of course, as many of you will know, if the beneficiary is actually resident in Scotland and is a maximum rate taxpayer, then because they have a slightly higher rate, an extra rate, if you like, that figure can actually go up to around about 91%.
Big number. So thank you for Steve and Niall and Chris for obviously just sort of explain that out like that. I want to ask, so what role does an independent advice play in this process, and how independent advisors work with product advisors to sort of deliver these solutions? Niall, do you want to sort of give us an overview on that one?
Yeah, I can do. So it's a sort of hand in glove experience in terms of if we're talking about specifically this issue. As Chris mentioned earlier on the call, we have a real good in-depth understanding and knowledge of where we are in terms of inheritance tax and the exposure. It does get a little bit more complicated when you add in the cross-jurisdiction element to it, but quite often the solutions and the answers available will call upon some other structure to be put in place. And thankfully, those people that are able to help with us on some of the technical questions, i.e. Steve, who's on the call today, we're able to have a really good in-depth conversation with the provider regarding the client's individual circumstances. But it is very, very tailored and it is very specific, because not two people typically want to do the same thing or have the same lifestyle. It's very, very easy in my experience to make the numbers work, but the harder aspect is the emotional impact, the lifestyle decisions, because quite often people don't entirely know if they're going to go back to the UK, if they're going to move abroad. We're talking specifically UK and Portugal, really, where we're based. But again, we have clients that are multi-jurisdictions with assets based in those as well. So there's a sort of additional layer of complexity when you add the cross-jurisdiction stuff in. So I would say it's obviously more important to speak with someone when you find yourself in that position. But we're very fortunate to have a really, really good relationship with Utmost and specifically with Steve. And we're certainly able to lean on him when we need some assistance.
So sort of staying with you, Niall. No, okay. So staying with you, Niall. Obviously, we often hear from expats who may consider moving back to the UK. How do these changes impact someone who decides to return, and what should they be thinking about in advance?
Yeah, again, the big winners of this are UK expats. To continue the theme of what we're talking about on IHT and also what I was laterally saying about people potentially returning back to the UK, then this budget is the gift that keeps on giving, really. There's a few nice additional bonuses in there, one being the sort of 10-year IHT exemption that you have. Steve's better at answering that than me. He's definitely into the technicals. But in simplest terms, if you are outside of the UK, you for the 10 of the 20 years, you would then potentially qualify for being a non-UK long-term resident. Again, depending on how long you were out, you return back to the UK, then theoretically the maximum period of time you could have would be a 10-year exemption on any, again, non-UK situation-based assets. So that provides a great opportunity from an IHT or inheritance tax planning situation. The other area that's of importance, and some people might have came across, is the foreign income and gains piece of legislation, which is looking to come through as well, or known as FIG, really, is the abbreviation on that one, where any non-UK, again, long-term residents, subject to the residency-based situation, can indeed have 4 years to bring non-UK, again, based assets back into the UK and experience tax-free gains on income tax and on capital gains tax. Now, of course, that sounds great, but you also then have to factor in and consider, well, what does that do from your IHT exposure? And I often quite say it's really, really simple, but with money, there's only two things you can do with it when it comes down to it, and that's either spend it or give it away. If you don't do either of those, then there's going to be some level of taxation involved. So there are really, really good, nice benefits that this budget has brought in for UK expats. But again, I know I keep sort of banging the drum on this one. It is really important to make sure that you do speak with someone that is well versed in these matters.
Lovely. Okay, thanks. Now, I'm really conscious of the time. We were trying to get obviously to everything within that sort of half an hour sort of mark, but obviously we've gone over. But I think it's obviously a really important subject. So if the audience can bear with this, there's still a few more sort of elements that we want to address, and then obviously we will try and get to some of those questions. As I said, if we don't get to the questions, or the questions sort of take us too far over the time, the Portugal Pathways team will get back to everybody individually, offering each individual the opportunity to have a discovery call to talk about their specific circumstances. But again, Chris, I'm gonna pull you into this particular question. So obviously pensions themselves have become a major focus under the UK budget. Chris, could you explain how these changes affect pensions specifically, and why this is such an important consideration for expats?
Well, I think as Steve and I were saying earlier, with pensions, the thing is that from 2027, this is the first time in a long time that pensions will form part of your UK estate. So they will then be taxed at 40%, just on the amount you have. And then, as Steve was saying, as you withdraw them, there are different ways. But I think the other part of it is what does bringing a pension into your estate do? And as Steve mentioned, it reduces all your other benefits. You know, if you've got £500,000 in pension, which is not an unreasonable number for people that have been saving for 30 years plus, you know, that takes you £500,000 closer to having an estate that's big enough that you no longer get the extra residence nil rate band. So again, I think one of the things that you look at is, and Noel was very, very, very clear on that, and I loved it. You know, you either spend it or you give it away. Now, one of the things there is actually with pensions now, spending it becomes a much better idea. And one of the ways that we work with clients is that we can, you know, particularly if you've got non-habitual residency in Portugal, you know, you can bring pensions into Portugal at, if you're lucky, at 0%. If you're a little bit later, you're still coming in at 10%. So you're taking a 10% tax charge to then put it into somewhere where you're avoiding a 40% tax charge. So again, very simply, that's how it can be done. But again, it's got to be right for your circumstances.
And also, again, sort of just keep it on that subject to a degree. How easy is it to manage sort of cross-border assets between the UK and Portugal? You know, what regulations do expats need to be aware of, and what solutions themselves are available? Niall and Chris will take that one.
Yeah, well, I'll take the first part of it. The first part of it is how easy is it to do? Well, it's one, you know, that's our job. You know, what we do is manage cross-border assets for clients, people that have got assets in the UK, people that have got assets in Portugal. Some people even have, you know, people who have assets around the world, Switzerland, the UAE, you know, various places. I think what we do is we work on and spend time with them to find out what their ambitions and goals are, and put together a holistic plan for them. What I'll do is I'll hand over to Niall now, because Niall is regulated both in the UK and in Portugal, which is, I think, is vital. If you need someone that knows both systems.
Yeah, cheers, Chris. Certainly, cross-border wise, it's more trickier, more complex than a single jurisdiction. You have to be familiar with the taxation environment in both. So again, if we pick UK and Portugal, it's important to be aware of what's happening in the UK, changes such as this, and also likely in Portugal, changes that are coming through as well. Not only that, it's then important to understand how the double taxation agreement between these countries interplay. And then another layer can be if you have any, for example, in Portugal, there was a non-habitual residence regime, which has been slowly fading out, but potentially replaced by something else. So then that adds another layer of complexity. So what I'm driving at, again, is that it's important to work with professionals, so advisors such as ourselves, lawyers, accountants, that are familiar with both jurisdictions, that have the sufficient experience, exposure, and the qualifications really to really give the client the best advice.
Brilliant, thank you, Niall. Again, you know, obviously I'm looking at the chat, and we've got obviously a number of questions coming in. I think we can probably take a couple of questions before we sort of wrap this up today. So let's look at some of these questions. So we got Andrew is asking, if I already have a tax plan in place, do I need to update it based on the new rules? So again, open up to the panel, and if anyone puts their hand up for that particular one. Chris, excellent.
Yeah, happy to. Depends on what your tax plan is, and it depends on you know, what your plans are for the future. But you know, happily, you know, a no obligation sit down meeting in Portugal, we'd happily come to you and have a chat about what you've currently got. If you're working with existing advisors, we can happily talk them through. But I would say that what this event has caused is, yes, you definitely need to review what you have in place. I don't know what Steve thinks on that.
Well, obviously, Chris, there have been major changes, and as far as inheritance tax is concerned, it major implications as to how it's calculated. So one would imagine that what was potentially the right solution before before 2025, may be different post 2025, and I think that's as far as I can say.
Brilliant. Thanks, Steve. We've got a really interesting question here from Brian. Brian asks, how exactly can international insurance bonds help reduce my inheritance tax liability? And is this something Chris or Niall at Beacon can help me with? Niall, do you want to have a answer that?
Yeah, sure thing. Yeah, I mean, obviously that's quite specific in terms of the products. We would want to make sure, again, firstly, that we understand what the client's exposure is to these things. But for the sake of the question, what you're looking to try and do then from an IHT point of view is, as we've kind of gone through, is reduce that UK exposure. Bonds themselves, if they're offshore, then whilst whilst they won't be sort of UK based, they'll be able to quite simply be offshore. Then it's one way, or one of the methods that we would consider and look at moving assets that are UK based. Again, let's call it the pension that we've talked about, potentially stripping that down, ways in which we might want to do that, looking at income tax, capital gains, all those types of things. But yes, putting it into a non-UK based, or in this case an offshore bond, would certainly be something that we would consider.
Excellent, thanks, Niall. And I'm just going to, I've got one more question before we sort of wrap up. This question is from Amelia, and she's asking, what happens to my inheritance tax liability if I transfer UK assets like property or savings to my children? Or am I best to move them to Portugal where there is no inheritance tax? Chris?
So with that one, it depends on where you are based, because you'll be, if you are still partly UK, if you're UK resident, then you're into the potentially exempt transfer rules if you transfer down to your children. If you then decide that you want to move the assets to Portugal, it still depends on your residency, long-term residency in the UK. Again, this is why everyone needs to sit down and talk to somebody, and as Niall said, we don't want to labour the point, but please take advice, because doing something for taxation reasons isn't always the right thing. It might be emotionally or financially, or your long-term planning. It might be that actually leaving them where they are is the right thing. It might be moving them to Portugal is the right thing. It might be doing something totally different is the right thing. But what I can guarantee you won't be what I can guarantee you won't lose out by is by sitting down and talking to a professionally qualified advisor and just running through the options, and then make a decision. Let's have a look at what you've got and make a decision.
Yeah, as I said, we said before, it's obviously in the chat. There are various ways to reach out to the team here at Portugal Pathways, and we will set up that sort of no obligation discovery call with Chris and Niall and other members of their team. Before we close, and I really appreciate the fact that that the audience has stuck with us, and obviously the panelists has given up their time, but we're sort of 15 minutes or so over. But before we do close, I'd like just to go around the room and ask each of our panelists to give sort of one takeaway in their own, in their own words. What does all this mean for UK Pats in Portugal, and what is the most important action that they should take now? So I'm going to start with Niall, then go to Steve.
Yeah, the budget has really opened up opportunities for UK expats now to look at ways in which to reduce their IHT exposure, both rightly around pensions, around other assets. Previously, it was a lot more difficult, a lot more complex, and while still being complex, the solution is much more straightforward now, which is get your assets potentially outside of the UK. Of course, then it's the best way in which to do that. But again, to re-emphasize the point, it's really important that you do speak with someone who is qualified, who has the experience and expertise in both the jurisdictions that the person would reside in.
Yeah, thanks, Noel. And Steve?
Yeah, for me, I think the biggest change is the one of certainty that it gives clients, gives individuals who have been outside the UK for 10 years. They know for certain, based upon simple mathematics, that they are no longer long-term residents, and therefore it's relatively easy to determine the inheritance tax liability. They never had that benefit before under domicile rules. That's the major change for me.
Thanks, Steve. And Chris, finally, your sort of takeaway points?
I think my takeaway points are many more people are being pulled into the UK inheritance tax net. You know, we've been talking a lot about expats, but you've seen what they've been doing, what the new government have been doing with businesses and farmers. If you've been following the news in the UK, this isn't going to go away. And you got anyone on this call who can be outside the UK for 10 years and become long-term non-resident, look at it, because this is a tax that will get bigger and bigger, and it's a tax that is relatively easy to avoid if you plan properly and it fits your lifestyle. I'm not saying to someone who's in the UK that for the sake of tax move away, but
yeah,
it does give the opportunity that if you've already decided that Portugal, the wonderful place Portugal is a place to live, our offices down in Quinta do Lago, we can come and visit you and see you and just talk you through anything wherever you are in Portugal. So yeah, my takeaway would be this is going to get worse, not better.
Absolutely. And thank you, guys, for your time today. Obviously, just before I go, we just want to really reiterate that Portugal Pathways, we've seen a surge of inquiries about the UK budget, inheritance tax and pensions in the recent weeks. I mean, there's many fear that the UK government might end up as the biggest beneficiary of their hard-earned assets. And with UK pensions now being factored into inheritance tax calculations, we're hearing loud and clear that UK expats want to enjoy expats want to enjoy what they have built with their families and not HMRC. I mean, the good news is that we've heard that UK expats are potential big winners if they take early action, and they can get peace of mind and clarity from the experts we have on today's webinar. So please reach out to us to arrange that sort of no obligation discovery call. It'd be well worth your time. And the guys here will either arrange a face-to-face meeting with you or obviously over a video call, just so that they can get clarity on your personal situation and see how you can benefit from those changes. Just before we go as well, I just need to sort of reiterate, from a disclaimer point of view. I'm sharing a slide, which isn't loading at the moment. Bear with me 2 seconds.
Steve will be very pleased this slide's up.
There you go. Yeah, Steve will be very pleased this slide's up. So it's important that you seek individual professional advice, as the information given by our panel is information purposes only. And any formal advice would be in a follow-up meeting with an independent financial advisor, such as Beacon Global Wealth Management. So obviously we have to say that. And so that has put Steve's mind at rest, I'm sure. And it really just leaves me to say thank you very much to our, bear with me 2 seconds of my playing up a little bit. It just leaves me to say thank you very much, obviously, to the audience first and foremost. We appreciate your time today. Apologies that we've gone slightly over. Big thank you to the panelists who have obviously reiterated and given clarity to this situation. We've got our next webinar in 2025, and it's all around investing in Portugal's future. And so that is up on our website if you wanted to register for that. It just leaves me again to say thank you to everybody for today's webinar. And Portugal Pathways would like to wish our panelists and our audience a happy Christmas and a prosperous new year. Thank you very much, and we'll see you in 2025.